Hey, single stocks are trailing the S&P 500 by the widest margin since 1999. Only about 1/3 of the stocks in the index are actually outperforming the index. We haven't seen that since just before the dot-com bust, and some of us worry that stocks might be getting very expensive at this point. This may be a good time for most investors to consider diversifying their portfolio if they haven't already. Spreading the risk outside of just the things that you hear about all the time, like the S&P 500, like the Magnificent Seven stocks, might be a reasonable strategy to take at this point. We've had 2 years of the S&P performing very well, which means that the underlying stocks are quite expensive by historical standards. And as financial planners, we're afraid that anyone that pins their hope on the S&P performing like this every single year might be sorely disappointed. I remember a time in 1999 when investors thought the S&P could do no wrong. They invested their entire retirement portfolio in that single index and it dropped by half. They also thought they could withdraw 10% a year in retirement and live off of that forever. If you take 10% off that portfolio and then experience a 50% decline, you now only have 45% of your original principal. That's not a very good recipe for recovery and a long and enduring retirement income strategy.